Your first $1,000 invested will probably make you about $70 this year, and that's the most important $70 you'll ever earn. Most people think investing is this complicated Wall Street thing where you need to pick the right stocks, time the market perfectly, and stare at charts all day. It's not. The actual process of investing your first $1,000 takes about 15 minutes, requires zero financial expertise, and the hardest part is just starting. Today, we're walking through exactly where to put that money, what to buy, and why the amount doesn't matter nearly as much as the fact that you did it at all. Welcome back to Capital and Capybaras. Let's address the elephant in the room. $1,000 isn't going to make you rich. At an average market return of 10%, that's $100 in year one, before inflation, not exactly quit your job money. So why bother? Because the first 1,000 isn't about the returns. It's about crossing the psychological barrier between person who saves and person who invests. Those are fundamentally different identities. Savers protect money. Investors make money work. And once you've invested that first 1,000, the second 1,000 is easy. The 10th 1,000 is automatic. The 100th 1,000 is inevitable. That first investment changes your behavior, not just your balance. Plus, that $1,000 invested at age 25. At 10% average returns, it's $17,000 by retirement. You literally did nothing except not touch it. That's the power of time we talked about in episode 1. Step 1. You need an account, not a savings account, an investment account. There are 3 main types, and I'll make this simple. A regular brokerage account is like a checking account for investments. No special tax rules, no restrictions. You put money in, you invest it, you can take it out whenever you want. No age limits, no penalties. It's the most flexible option. A Roth IRA is the account most beginners should open first. You put in money you've already paid taxes on, it grows tax-free, and you pull it out tax-free in retirement. Free growth. The government basically says, we won't tax any of your gains ever. The catch, you can only contribute $6,500 a year, and you need earned income. But for your first 1,000, a Roth IRA is almost always the right answer. A 401k is through your employer. If they match contributions, that's free money. We'll cover that in detail in episode 10. For now, just know it exists. But for your first independent $1,000, a Roth IRA or brokerage account is where you're headed. Where to actually open the account? Fidelity, Schwab, or Vanguard? Pick one. They're all fine. They all have zero-fee accounts and zero-commission trades. Don't overthink this. It's like choosing between 3 identical water bottles. Just grab one and start drinking. Account is open. Money is deposited. Now what do you actually buy? This is where people freeze. There are thousands of stocks, bonds, mutual funds, ETFs. The options are overwhelming. So here's the answer that financial advisors charge hundreds of dollars to tell you. Buy a total stock market index fund. That's it. One fund. Done. An index fund owns a tiny piece of every major company in America. When you buy one share of a total stock market index fund, you own a sliver of Apple, Google, Amazon, your local bank, that company that makes the ketchup you like, all of them. Instant diversification. You're not betting on one company. You're betting on the entire American economy. And historically, that bet has paid off at about 10% per year for the last century. The specific funds to look for: VTI or VTSAX at Vanguard, FSCAX at Fidelity, SWTSX at Schwab. These are all basically the same thing, a basket of every publicly traded company in the US. The expense ratios are between 0.01 and 0.03%. That means for every $1,000 invested, you're paying about 3 cents a year in fees. Not 3%. 3 cents. What about individual stocks? What about crypto? What about that thing your coworker won't shut up about? No, not with your first 1,000. Maybe later, with money you can afford to lose, you can play around. But your foundation should be boring, diversified, and cheap. Exciting investments are for people who already have a boring, diversified, cheap foundation. Let me walk you through the exact steps. This takes about 15 minutes. Step 1. Go to Fidelity, Schwab, or Vanguard's website. Click Open an account. Choose Roth IRA if you're eligible, brokerage if not. You'll need your social security number, bank account info, and about 10 minutes of form filling. It's less complicated than signing up for most streaming services. Step 2. Link your bank account and transfer $1,000. This usually takes 1 to 3 business days. You'll get a notification when it arrives. The money will sit in a settlement account as cash. It's in your investment account, but not yet invested. This trips people up. Having money in an investment account doesn't mean it's invested. You have to actually buy something. Step 3. Search for the index fund. Type VTI or FSCAX or whatever your platform's equivalent is. Click Buy. Enter the amount $1,000. For ETFs like VTI, you might need to buy in whole shares, so you'd buy as many shares as you can afford, and the rest sits as cash. For mutual funds like FSCAX, you can invest the exact dollar amount. Hit Confirm. You're an investor now. Step 4, and this is the most important step. Do nothing. Don't check it every day. Don't panic when it drops 3%. Don't sell because someone on the news said something scary. The average investor who checks their portfolio daily earns significantly less than the average investor who checks quarterly. The best investors are the ones who forget their password. Now let's address the fears that keep people from doing this. What if the market crashes right after I invest? It might. In 2020, the market dropped 34% in a month. If you'd invested $1,000 at the exact peak before that crash, you'd have had $660 a month later. Terrifying, right? By the end of that same year, you'd have been back to about $1,000. 2 years later, you'd have been at $1,200. The people who panicked and sold locked in their losses. The people who did nothing, they're fine. What if I invest and need the money? If your $1,000 is your emergency fund, don't invest it. Go back to episode 2. This should be money beyond your emergency fund. But if you do need it from a taxable brokerage, you can sell and withdraw anytime. From a Roth IRA, you can always pull out your contributions penalty-free. The gains have to stay until retirement, but your original money is always accessible. I don't have $1,000. Then start with 100, or 50, or 10. Fidelity lets you open an account with $0. Many index fund ETFs trade for under $300 per share, and most brokerages allow fractional shares now. The number doesn't matter, the habit matters. Someone investing $50 a month will end up wealthier than someone who waits 5 years to invest $5,000. Here's the recap. Open a Roth IRA at Fidelity, Schwab, or Vanguard. Buy a total stock market index fund, VTI, FSCAX, or SWTSX. Then do absolutely nothing. The process takes 15 minutes. The hardest part is deciding to start. Your first $1,000 won't make you rich, but it will make you an investor. And investors build wealth. Time in the market beats timing the market. Your couch cushion probably charges higher fees than these index funds. And the best investment strategy known to humanity is buying boring index funds and then forgetting your password. If this episode finally convinced you to open that account, hit subscribe. Next time, we're demystifying the stock market itself, what it actually is, how it works, and why it's less like gambling than people think. Drop a comment with your first investment story, or tell us what's still holding you back. No judgment. Everyone started somewhere, including the people who now act like they were born knowing what an ETF was. And if you haven't built your emergency fund yet, go watch episode 2 first. Invest after you have a safety net. Stay chill, buy the index, forget the password.